Understanding capital gains. Tax is crucial for every investor. This concept is well explained by Suze Orman in her book, The Ultimate Retirement Guide for 50+. Investing is an exciting journey toward financial freedom, filled with opportunities to grow your wealth. But with profits come taxes, an inevitable part of the investment process. In India, we refer to this as capital gains tax, a term every investor should be familiar with. Simply put, it's the tax you pay on the profit you make when you sell an investment for more than you paid for it. This profit is known as a capital gain. This tax applies to many types of investments, but let's focus on three popular ones that most people are familiar with: stocks, mutual funds, and real estate. Each of these has its own set of rules and tax implications. Now, before you start to worry, remember, it's not just about how much profit you make, but also about how long you hold on to your investment. The duration for which you hold your investment determines whether your gains are classified as short-term or long-term, each with its own tax rates and implications. Understanding these nuances can help you make smart investment choices and minimize your tax liability, ensuring you keep more of your hard-earned money. Remember, knowledge is power. By understanding your tax obligations, you empower yourself to invest wisely and secure your financial future, paving the way for a prosperous life. Short-term versus long-term gains. Let's break down the difference between short-term and long-term capital gains. The key factor here is the holding period, how long you hold on to your investment before selling it. This period differs depending on the type of asset. For stocks and mutual funds, a holding period of up to 12 months classifies the gain as short-term. Hold on to them for more than 12 months, and you're looking at long-term capital gains. Real estate has a different timeline. Any property held for 24 months or less falls under short-term gains, while anything beyond that is considered long-term. Why is this distinction so important? Because it directly impacts how much tax you pay. Short-term gains are taxed at your regular income tax slab rates, which can be higher. Long-term gains, however, generally enjoy lower, more favorable tax rates. Tax rates, stocks, mutual funds, and real estate. Now let's talk numbers. The tax rates for capital gains vary depending on the asset class and the holding period. For stocks and equity mutual funds, short-term gains are taxed at 15%. Long-term gains are taxed at a flat rate of 10% for gains exceeding 1 lakh rupees in a financial year. For real estate, short-term gains are taxed as per your income tax slab rate. Long-term gains, however, are taxed at 20%. But here's where it gets interesting. You can reduce your tax burden on long-term gains from real estate through a process called indexation. Remember, these rates are subject to change based on government policies. It's always a good idea to stay updated on the latest tax regulations. Don't hesitate to consult a tax advisor for personalized guidance. Indexation, reducing your tax burden. Indexation. It sounds complicated, but is actually a helpful tool for long-term investors, especially in real estate. It's a method that can significantly lower the amount of tax you owe when you sell an asset. Remember how inflation eats away at your money's purchasing power over time. Indexation factors this in. It adjusts the purchase price of your asset to reflect inflation, ensuring that your gains are measured in real terms. It allows you to adjust the purchase price of your asset upwards based on inflation, effectively reducing your taxable profit. Let me explain how this works in a bit more detail. Let's say you bought a property for 50 lakhs in 2010 and sold it for 1 crore in 2024. At first glance, it seems like you made a profit of 50 lakhs. Without indexation, your taxable profit would indeed be 50 lakhs. This would mean a significant tax liability. But indexation lets you factor in the inflation between 2010 and 2024, increasing your purchase price to, say, 75 lakhs. This adjustment is crucial. Now your taxable profit is only 25 lakhs, resulting in lower capital gains tax. This means you keep more of your hard-earned money. Indexation is a valuable tool for reducing your long-term capital gains tax liability. It's especially beneficial for assets held over a long period, where inflation can significantly impact the real value of your gains. It helps you account for the real value of your investment in today's terms. ensuring you're not unfairly taxed on inflated profits. By using indexation, you can make more informed decisions about your investments and tax planning. So next time you're planning your investments, consider how indexation can work for you. It's a smart way to manage your tax burden and maximize your returns. Exemptions. Section 54 and Section 54F. Hold on, there's more good news. If you're looking to save on your capital gains tax, you might want to pay close attention. The Indian government offers exemptions to minimize your capital gains tax burden under certain conditions. These exemptions can be a game changer for your financial planning. Two important ones are Section 54 and Section 54F of the Income Tax Act. These sections provide specific guidelines and benefits that can help you save a significant amount of money. Section 54 applies specifically to long-term capital gains from the sale of a residential property. This means if you sell your home and make a profit, you can potentially avoid paying hefty taxes on those gains. It allows you to reinvest the capital gains into another residential property to save on taxes. This reinvestment must be done within a specified period to qualify for the exemption. The reinvestment can be in one property or two, under certain conditions, and should be within specified timelines. Typically, you have 2 years to buy a new property or 3 years to construct one. Section 54F broadens the scope. Unlike Section 54, which is limited to residential properties, Section 54F applies to long-term capital gains from any asset. It applies to long-term capital gains from any asset, not just residential property. This means you can sell stocks, bonds, or other investments and still benefit from this exemption. You can claim this exemption if you reinvest the gains into buying or constructing a residential property. The key is that the new investment must be in residential real estate. However, there are conditions related to the investment amount and timelines. For instance, the entire sale proceeds must be reinvested to claim the full exemption. These exemptions can significantly reduce your tax liability when you reinvest your capital gains wisely. By understanding and utilizing these sections, you can make more informed financial decisions. However, it's crucial to understand the specific conditions and consult a tax advisor to ensure you meet all the requirements for claiming them. Proper guidance can help you navigate the complexities and maximize your benefits. Debt mutual funds, a special case. So far, we've focused on stocks, equity mutual funds, and real estate. Now let's address a special case, debt mutual funds. While they are considered safer than equity, their tax treatment differs slightly. Short-term capital gains on debt funds are taxed as per your income tax slab rate. However, long-term capital gains are taxed at 20% with the benefit of indexation. This means you can adjust your purchase price for inflation, reducing your taxable gains and ultimately your tax liability. Understanding the tax implications of different investment avenues is crucial. While debt funds offer stability, knowing their tax treatment helps you make informed decisions aligned with your financial goals. Reporting capital gains, what you need to know. Now that you understand the basics of capital gains tax, let's talk about reporting it. When filing your income tax return, you must accurately report any capital gains you've earned during the financial year. This includes gains from stocks, mutual funds, and real estate. For each asset class, you'll need to provide details like the date of acquisition, date of sale, purchase price, sale price, and any applicable exemptions or deductions. Maintaining proper records of your investments, including purchase and sale documents, is crucial for accurate reporting. Accurate and timely reporting ensures you comply with tax regulations and avoid any penalties. If you're unsure about the process, seeking professional assistance from a chartered accountant can simplify things. Conclusion: making informed investment decisions. Understanding capital gains tax in India is non-negotiable for any investor. Knowing the difference between short-term and long-term gains, tax rates for different assets, and available exemptions like Section 54 and 54F empowers you to make informed investment decisions. Remember, it's not just about maximizing profits, but also minimizing your tax liability. By understanding the tax implications of your investment choices, you can optimize your returns and secure your financial future. Keep learning, stay informed, and consult a tax advisor when needed. Investing wisely and responsibly is the key to achieving your financial goals.